Um, Shall we start? Yeah. Good morning, everyone. Welcome to this African Power Generation session. My name is Renu Gupta. I have a wide range of experience in oil and gas industry and capital markets, and I advise boards of independent oil and gas companies. We have an excellent mix of speakers in our panel, representing both the corporate and investment side. So let me introduce you from this side. Chris McLean is an Africa-focused investor, and he has been actively involved with venture capital projects throughout his career. We have Roger Brown from Seplat, which is a Nigeria-focused oil and gas company and a big player in Nigerian gas-to-power market. We have Minesh Mishru. He's a private equity investor. Again, a lot of experience in investing in infrastructure and power projects in Africa. And we have Amit Dek, who is CEO of Victoria Oil and Gas, a big player in gas-to-power market in Cameroon. And we have Ignacio de Colon, who is Chief Investment Officer based in London for International Finance Corporation. Again, a big financier in the African power generation market or gas-to-power market. So let me start with my first question, which is from all panelists, basically, to talk about how do you see opportunities in African gas-to-power market, and how do you compare gas to other renewable energy sources in those markets? So shall we start with the investment side, and then we come to the corporate speakers? So Chris first.
Hello, there we go. Good stuff. The opportunity in gas market in Africa is much larger than I think most people expect. And I think it purely has to do with two features. The lack of investment that Africa has seen to date, which means there's a lack of infrastructure. And then it also goes with demography, is to say the next billion people on the earth are projected to be on the African continent by 2050, which says there is an immense demand that has to go with this. So as a result, as a venture capitalist, private investor, the opportunities exist and they abound for forward thinking to look at those opportunities. It's not about creating a rate of return in the near term and having cash flow tomorrow, because there has to be infrastructure investment that goes alongside it. It's about having a long-term value creation thought to it and looking more at NPVs.
Minesh?
Okay, hello. I think I take a similar view in terms of looking at a thematic approach. Africa itself only has, well, in general population, only has 43% of people have access to power. That's a huge issue in itself. Despite that, you see consumption growth at around 3.2% per annum. So there is certainly a market there. You know, as the continent itself starts to urbanize. When I talk about Africa, I'm really referring to sub-Saharan Africa in particular. So there's obviously a huge opportunity, but having said that, in the last 5 years, infrastructure projects in Africa actually declined from the 5 years before, mainly because of the ability to, one, get deals done, and then the commodity downturn has had a huge impact. So as an investor, there's clearly fundamentals that point to the direction, but there are great challenges at the end of that as well, because when it comes to gas projects in particular, you know, like we were talking about earlier, it's a huge value chain and a huge amount of investment and things that need to be done at several different levels. So as an investor going into there with a finite lifetime, the ability to kind of wait that out is a challenge. That is where something like renewables and IPPs have an element of advantage, because it can be more nimble, more off-grid, smaller, more financeable. And hence, you've started to see a movement towards that. Gas will ultimately play a long-term role in the solution for the continent, given the reserves that exist on the continent. But you have to be relatively flexible in terms of where the environment is. And at the moment, the environment is is a little bit more challenging, particularly given who your off-take is into and how that is funded, given constraints that exist within governments.
Okay. Let us hear from Ignacio.
Yeah, so I'm from the IFC, so part of the World Bank Group, and we invest approximately, $15 billion a year in emerging markets, but of that, about $3 to $4 billion a year in Africa and sub-Saharan Africa. And a lot of that $3 to $4 billion is in the infrastructure space. I think we've financed approximately 70% of the IPPs in sub-Saharan Africa that have actually been financed. Fully agree with the comments before. There's a huge potential in Africa, given population growth, urbanization, all these things. I think the question is, why isn't there more being done? And I think there's a lot of tragic stories in terms of availability of gas, availability of a potential market, and yet nothing is getting done. And there it really is the regulatory environment and how the markets are set up. And I think within IFC, we've sort of we're going through a new strategy called creating markets. So if we sit on our backsides waiting for projects to come to us fully cooked, we're going to be waiting a long time, and it's going to take a long time for people to get power. So it's really having that proactive approach together with our World Bank colleagues on the policy side to really unlock these markets, help governments change the regulatory environment so that you can flood in, quote unquote, the private sector. One example of that, not necessarily in the gas to power space, but in the solar and renewable space that we're doing is, we work with the Zambian government to put in place what we call a scaling solar project, where they're bidding out solar projects on sort of set terms. We've done that in Egypt as well, where it's been extremely successful. Again, a set template of terms that can be rolled out in, I think we did about 13 small solar projects. We're doing it in Senegal as well. So really working with governments to scale up private sector investment in the power sector, because the key tragedy in many African countries has been the regulatory environment and whether it be subsidies, whether it be non-payment, whether it be SOEs which are dysfunctional, et cetera, which have prevented more investment from going in.
Yeah, before I turn to our corporate sector, we started talking about policy and all the challenges across the value chain. How do you supply gas? So that is where the oil and gas companies come in. And at the policy level, probably oil and gas companies deal more with the governments, and we have other side of policy making, as you said, World Bank and financial institutions who support these kind of projects. So how do they work together? But that's the macro question. I'll come back later. At the moment, I'll ask Roger to express his view, and then folled by Ahmed.
Thank you. It's a given, right? There's huge opportunity. There's huge demand. Africa, everyone comes up with the same quotes. 600 million people without electricity. That's going to grow, if you believe the numbers, by 1 billion or 1.2 billion. And I've been in Africa for quite a number of years doing this, as most people in the panel have, and it's depressing, right? Because there hasn't been growth. There hasn't been the meeting of the objectives everyone's trying to do, and we need scale, right? So if you look at the powering Africa, and I'm going to talk to you about Nigeria in a second, because we're based there and very active in Nigeria. There hasn't been the scale investment you need. We can talk about renewables and everything else, and it's nice to talk about that from an environmental perspective, but that's not a good baseload for a grid system, for instance, and it's really stunting the growth across Africa. There's any amount of money that wants to come into Africa, but for the years it's never kind of figured out how best to do it, and then maybe it is a regulatory issue with governments, it's currency issue, it's how to do it. It's, to be honest with you, and I'll be slightly controversial, it's development money fighting against commercial money, right? And that's often the case, and I'm glad that Ignatius is talking about really going to the root of the problem to fix the regulatory, to assist governments, to enable governments to get projects over the line and over, because there's any amount of commercial money available, but it's not going to go in unless it's well looked after and comfortable. If I specifically talk about Nigeria, it's just off the charts, the numbers. You've got the biggest population in Africa, and if you believe the 2050 numbers, it's going to be the third most populous place in the world. So it's going to go from 170 million people to 500 to 600 million people. And today the grid in Nigeria is effective grid's 12,000 megawatts of the nameplate. It's actually operating on 3,000 to 4,000 megawatts a day, right? And that's just for 170 million people. That's growing rapidly. So, what do Nigeria need? What other countries need is scale development, right? And this is where we come very much down to the same answer, which is what's going to give that scale development, and it's going to be gas. Yeah. And it's gas, the power story. So I'll pause because I'm sure Victoria wants to talk a lot about that.
Yeah.
Thanks, Roger. Yeah, look, I think an important factor is government regulation, and one of the key things that we look for, and we do look at additional projects outside of Cameroon, and we believe we're not ready for it as yet. Lot to do in Cameroon for ourselves, but a key issue, and I think Nigeria had this for some time, is the gas pricing, the regulation of the gas price, which detracts from foreign investment into countries. I mean, you can't drill wells, lay pipe, and install infrastructure for $2.50 or $3 per MMBTU in terms of a return. It just doesn't work. The numbers don't add up. A number of countries are in that position. The benefit we have in Cameroon is that government recognises that, realises that the gas price should not be regulated. We're in discussion with them on a regular basis to ensure that, as they would see it sometimes, we're not raping and pillaging the country in terms of taking out their resources and paying profits up to London, which is not the case. But it's conducive to foreign investment into country, and it keeps attracting foreign investment. IPPs want to keep coming in. We've just drilled 2 wells and completed that, and then we've got now available gas to be able to deliver on a 1,700 megawatt shortage. We're looking to deliver about a quarter of that at the moment, and with 3 IPPs that are ready to move into the country. So the attractive factor there is obviously sort of minimise regulation to a degree to be able to attract that sort of investment. And I looked at Nigeria some time ago and Tanzania as well, and one of the key aspects for us was we just can't make money there. It just doesn't work. And and I guess if you've got some sunk capital, I guess the model kind of works for you. But I think with some pressure, with the IFCs, the World Banks, to be able to get that increase of power to Africans in every African country. I mean, there's shortage of power in every African country. There needs to be an entire Africa change in terms of they need to allow the gas price and the returns on revenue, returns on investment, to make it attractive to be able to focus foreign investment into the country. One country that does it quite well, and we've looked at some investments there, is Cote d'Ivoire, who effectively have a model where they allow for a certain IRR for the investor to receive. And once you've hit that IRR, then effectively the gas price reduces to a certain level, and it actually makes it more affordable in country type thing. So that's kind of I guess the important factor that we see attracts investment in the country. And the other element, it's only the smaller companies, and I think it's the like of Seplat, ourselves, and Orca, and a few others in Tanzania, who've actually done some of these gas to power and actually discovered gas in country and kept the gas onshore or into the country. Everyone else find it simpler and easier to build an FLNG plant and just throw the gas into the export market. It's a commodity. It's got a price. It's got buyers. It's a lot easier to deal with rather than laying pipe and getting payment from customers in country. One of the important aspects we focused on in country was to have a split between state-owned. Well, we don't have any state-owned enterprise in control of any of our grid power customers, and it's all run by Actis and Global out of the UK. But we've got a spread of 32 customers, so we've got industry who's actually paying us as well as grid power customer paying us. So we're not one customer, we're actually 32 customers who are actually receiving a revenue and keeping us in business.
Yeah, can I have a quick comment on the pricing, like unregulated prices versus regulated, how important it is for this gas to power market and to have the supply of gas basically for power projects?
It's a tough one, right? Because that is, so you're going to win one side and lose on the other side.
Yeah.
It has to be sustainable. That gas price has to be sustainable long term. I'll specifically talk about what we've found over the years. We started investing in gas in Nigeria. We bought our assets in 2010. We started to upgrade our infrastructure in 2012. At that point, when we took over, it was it was about 10 cents a million scuff gas price in Nigeria. So ludicrous, right? You just, it was almost a headache. And what happened was, over the years, just how we sort of drove up, we have the domestic supply obligation pricing in Nigeria, and that has gone from that level to $2.50. And at $2.50, now it may not work if you put a lot of infrastructure in, but $2.50 works within Nigeria in a context. Willing buyer, willing seller is now $3, $3.50. So that's Henry Hub kind of levels. And it'd be nice to have 4, 5, 6. But in reality, that starts to make sense, and people are starting to come in and invest on those levels. So it's a double-edged sword. You have to set sustainable long-term levels in gas pricing, but the most important thing is getting paid for it. So that is where, going back to the regulations, is making sure that the supply chain or the value chain collects from the customers, from electricity, and then it goes right through the system. And that's where a lot of countries need help, particularly Nigeria and others.
Yeah. Maybe if I pick that up, though, it also didn't go into the power side in terms of pricing there. I think one of the challenges you have then, you can have a commercial customer who's the underlying offtake for the gas, but then generally if you build, a particularly large power facility, some of the ones in Nigeria we'll talk about, something like Azura or something like that, you're going to have a PPA into the government. And there's been a lot of negotiation around prices there. If you try to target something that works from an investor perspective, you're looking probably at 15 cents plus kilowatt per hour. But then there are long-term challenges in the viability of that. And if you consider in developed markets, or even in more developing markets, that power prices are closer to 5, 6 cents, it's not sustainable. And the challenge for that is, I think the gas suppliers are right. They are pricing under market, they're not the problem. It's everything else that's in between in terms of the costs in the structure. Developing the pipeline, security that goes around that. If you're having meager insurance when development banks come in, cost of financing of those sort of structures, just general logistics and additional construction costs of the actual underlying facilities, which you then need to price into it, and then risk factors that investors look for as well, mean that you're driving price into pretty difficult levels. We looked at projects in Ghana where we were being offered 23 cents per kilowatt hour, and higher on some, and actually in renewable as well, which sounds terrific. But then the challenge for us is, how viable is that in the long term? Because, our investment parameters in the concession is 20-year plus. So even if we're exiting before, we need to think about what the next person coming in will think about that, and can the government sustain that, particularly given it's all dollar-based, so they have less control of that system as well. So I think, pricing is still probably too high on the power side, but it has to be, and that's really an issue, as I kind of said to summarize, within the value chain.
Yeah, I mean, last year, I don't know how many of you were there in the sessions where some of our panelists were very much averse to political risk in Africa. I suppose everyone in the audience is attracted to Africa who is there. So I will take this opportunity to take a question from the audience at this point. How do you whatever question you have from the panel, basically. Any word? Okay, so I'll fire away. As I said, many many investors perceive high political risk in Africa. So how do you weigh, as an investor, risk and reward in Africa? Especially, there's a higher cost of capital and all those things. So from investors' perspective, how do you weigh these risk versus rewards? I can start with Chris.
Fair enough. So I think the way to look at the continent is to look at it to say, you can't judge the whole continent as one whole piece. You have to look at, individual countries have different above ground and below ground risks. So I think the reality of that we're talking through about the different economics on the projects, that may be the case in Nigeria. It may not be the case in Kenya, right? It may not be the case in Mozambique or South Africa. Every situation is a microcosm unto itself, and we're talking about vast, vast areas that need infrastructure and need investment. So in understanding the risk that goes with it, it truly becomes about the management team that you have, that you're looking at investing in, what their relationships are in country, who your support network is in country alongside with government that wants to advocate this progression forward. Is it a mandate for the government to move it forward? Rolling a stone uphill is never easy, and that doesn't make for good investments, or it makes for a longer term horizon. So I think the reality of it is to say is, we can all be advocates for, say, we want good base load in a country, we want renewables in a country, but if there is not a mandate from the top down that is, and by that I mean government, both intergovernmental, domestic governmental, and even regional governmental, then any projects going forward are always going to have hurdles. Now, to say prices change and things change, I'm from Alberta. Taxes change, governments change. We had how many things change in Canada in the last year with oil prices? And we're a first world country. Like, if that happened in Africa, it would go be all over headlines around the world, right? So the reality is there is nowhere safe where there is constant parameters in pricing. The issues here become, with an investment dollar going in, how do you want to see your exit going into the project, and what is your, are you a social cause or are you a benefit cause for your shareholders? Because too many times as shareholders in companies and potential investments, we mix in the social causes and say, this is good for the country, this is good for that. That's not a business case. That's a secondary benefit that comes from it. If that benefit if the objectives come top down, then there is an investment case to make. Otherwise, it's right now not the right time to be an advocate for those kind of investments.
Ignacio?
Yeah, well, look, I think political risk is political risk. I think the question is, what can you do to minimize political risk? One is a good assessment of the country and the, I think, Christopher, as you were saying, the sort of political will and dynamics. The other thing is to make sure you don't partner with the wrong people. That's an obvious one, but it goes without saying. I think the third is fairness of the deals. So if you feel that a deal is not sustainable, it can be Spain, and things can be renegotiated. So I think you shouldn't be a fool to think that just because you've got a contract, you've got a contract. It can happen anywhere. And then sort of transparency, and this is more on the upstream side of things as well. We're advocates, at least at the IFC World Bank. We go beyond EITI and all these things, and actually request that the companies that we invest in publish their concession agreements, publish agreements with government. Our view is it's better to have an open debate up front before you sink in a few $1 billion than it coming once you've sunk the couple of $1 billion into the country. So best to have that debate out in the public up front, so that you can't be accused of doing things behind closed doors by subsequent administration or whoever it may be. So again, I think it's a question of seeing how you mitigate those risks. There are countries that are basket cases, quite honestly, and best not to go there because there's no political will, there's no thing. But I think for the others, you can mitigate, at least to a certain extent, that political risk.
Roger?
Yeah, I mean,
Yeah?
I agree with a lot of that. I mean, but we can all talk about it. The thing is, what are we going to do about the change things?
Yes.
I think, and the reality is, every country is different. And to talk about one continent, it's not one continent. It's a continent of Africa, but it's so vastly different. Where do you start, right? And do you do does capital do across Africa, and we'll do each bit, or do we focus on the areas with the most demand? The most, like Kenya, or it's be Nigeria or wherever else. So let me talk about Nigeria specifically, because obviously we spent a lot of time there. That is, on a piece of paper, fixable, hugely fixable, right? Because in Nigeria specifically, and you don't see that across the whole of Africa, is you've got customers that are paying. So in Nigeria, what happens today is that they import diesel. So if you're living in Nigeria, you have got a diesel generator, and you're firing that 22 hours a day with imported diesel coming in from Europe, right? Even though Nigeria's got a huge amount of crude oil, it's got massive amounts of gas, right? It had refineries in country, but they are dilapidated. Because in Nigeria, people are more incentivized to import diesel and export oil. And what's going to happen is now if you're living there, you're spending 5 times what you should be paying for power. So you're paying for it anyway, right? So why don't you then take gas from the grid and power from the grid supplied by gas? Well, the reason being is because you haven't got the reliability, you haven't got the trust in it, you've got some distribution issues you've got to solve. But if you could solve them, you're going to take that power from the grid. And that's going to happen then is there's going to be a snowball effect. Because as soon as you get that grid to probably double the size it is today, then you get more and more people will get more reliability from the grid, and they won't use diesel. And Nigeria's currency problems is because all that money has been spent importing diesel. So it solves the currency, so therefore the naira strengthens, and therefore all the sort of currency things that stop power getting done in country starts to alleviate. So that's specific for Nigeria, and you could give other examples in Kenya and elsewhere, but it's not one size fits all. And as I go back to the capital, capital is kind of, I mean, I used to be in banking, but we always used to try and figure out is what project do you go into, what project is going to close. You don't want to spend 6 years, with a 450 megawatt power plant, and 6 years later you might get the deal done, right? So you're trying to sort of plot which one's likely to get done, and you're trying to work out all the sort of attributes of all of that. And that's a difficulty. You need to demystify all of that. Everyone on the panel here and in the room here, demystify that for capital so they can understand how they can get in. I think your point was, how do you get your exit? How do you get your return? That's critical.
Yeah. And having an open dialogue with the government from the outset, as Ignacio put it.
Well, so, I mean, in terms of IFC and the World Bank, the way we're looking at it now is we have to go full blast. So we have to fix the whole value chain, because if there's a part of the value chain that doesn't work, again, there's no use. So, as an example, in Ghana, we recently financed the Sankofa project with ENI and Vitol, and as a World Bank group, I think we put in about $1.5 billion of money at risk. But not only that, it comes with a whole policy dialogue, a downstream, a privatization, et cetera, et cetera. And our view is we need to do it in a big way. We need to have that systematic whole value chain dialogue with the government and put in major resources at a country level if we're going to be able to achieve something. And jury's still out. We'll see if we're able to fix the issues that Ghana has been having. But that's the way we're trying to approach things now.
How much time have we got now? 11. Oh, okay. Yeah. So, Minesh, do you want to comment on this aspect?
Sure. I think what Ignacio was saying in terms of understanding a market before you're going in there and doing the diligence that's needed is absolutely key. I think a lot of stakeholders that look at projects maybe just don't have the time or the capacity to really understand a market. Hence, they'll always kind of point you down the political risk insurance and these sort of factors, or they'll just pull out basically. That's a real cost to investors. So, I would always advocate, going to markets where you've got the time and the ability to kind of undertake that diligence and be comfortable. Obviously, you can't cater for everything. So if you're there for the long term, then clearly you can ride the cycle and survive when things, which they inevitably will go wrong. And I think that's absolutely key. You've got to be really, a long-term player in a market. So that's really from an implementation basis, and from an investor perspective, we're really looking for a way to understand a market and thereafter, really going in for the long term. I think there's a slight difference to a development play as well, because where it's implementable and where actually you can get more comfortable is not necessarily where the power is most needed and most investment is needed, and that's probably a harder task. And that's really where, I see challenges on several sides really. On development banks, even development banks often are pushed towards markets where it's easier to get deals done because they need to deploy capital, but not necessarily where it's absolutely needed. We can use examples across the continent, using DRC or something as an example, for instance, where it's great potential, but projects aren't getting done to the same degree. So I think that's one challenge. One other statistic I always kind of look towards is, when you think about private equity, generally globally, in developed markets, private equity represents around 2 to 3% of GDP globally, but that has a multiplier effect in itself to kind of draw in more capital and take that early risk to really push projects forward, whereas in Africa that's around 1%. And one, you need to increase that, and you need to increase that so that you can actually develop bankable projects. And that's what's really going to drive it, developing bankable investable projects. And I hate the phrase. I really do hate the phrase, but, there's a whole system around that, around somebody invested in the policy and the regulation so that you don't need to invest so much additional capital to get that over the line, having robust PPAs in place, as we talked about earlier, having the supply chain sorted. The offtake is absolutely key, a sustainable offtake. And what that really comes down to is who's going to pay for the power in the end. Now, in the end, you want that to be the end consumer, you want that to be industry, which is why you're being pushed to more, I would say more developed markets within Africa right now, where there's greater industry off-takers as well, where you can be more comfortable that actually the government won't have a concern around that. And then the final point I would make is around currency. At the moment, everything is dollarized, and we talked about gas versus renewables. Well, when you have a huge multi-billion-dollar project, if you look at something like the Lapset development and everything around that, and the pipelines that are needed there, and then the power infrastructure that will come in as well, this is multi-billion dollars. It has to be dollarized in terms of the funding base that you're going for. When you start to look at smaller projects, you can maybe even start to think about a local currency solution. And that will really be a game changer. But then, you need funders who are prepared to kind of understand that and take that. And clearly then you would have a hedge on both sides, a natural hedge in a situation rather than having to kind of cost that. So I think currency is a substantial issue that we haven't discussed yet, and it's something, clearly as a continent there isn't a solution for, because you have 48 countries within sub-Saharan Africa, everyone basically apart from within West Africa, doesn't really have a currency union, and that's a big challenge for investors because you're always going to look at your dollar returns.
Do you think currency union would help, just like euro?
Well,
we have seen ups and downs of euro.
I think this is a completely different discussion, and we could be here forever. The problem is what the euro has taught the world is that having a currency union where you don't have a proper political union and control is nearly impossible. And who knows what will happen in the future. I'm not a fortune teller around that. But, trying to manage so many different markets together and bring in it would sound, it's a wonderful dream. And actually, I think for Africa, that could be an amazing dream where actually you start to kind of move away from dollarization of the continent to something different. But this is very long term. And at the moment, politics is so, discrete amongst one another. But you can see, the continent trying to kind of, through the African Union and other things, wanting to kind of reach further consensus. But it's a long, long way off. Yeah. It is a long way off. But perhaps in the long term, you can never say never. And it could, certainly, you could see the benefits. But how that all sticks together, who knows?
Yeah. I just wanted to hear from Amit as well, but it seems like bottom-up approach, combination of both, top-down and bottom-up. You identify which countries are good based on the investment criteria initially to go, demand side and regulatory framework and all the other issues which investors would like to know. But I would like to hear from Ahmed, because for you it's the country, you focused on one country. So how do you view all these solutions? How can they come together as a continent, or you deal with individual country level, educate each of the government of the country you go to?
I don't want to be saying that I educate any government whatsoever. I don't think any of us are capable of doing that. But I think Chris said earlier, every country has got its own merits. And each country itself has got its own different risks, political risk, commercial risk, any of those sort of elements. So, no, it's unfortunate. You can't just take it as a general approach to run in terms of Africa as a continent. We have specific criteria in what we look for in terms of assets, and if it doesn't fit those assets, we effectively don't go into. I think very similar in terms of a capital deployment situation. We want to see that if we are deploying capital, the returns are going to come in a particular period of time, and the projects are going to actually happen. A development plan with any asset we acquire in terms of a concession or a PSC needs to be already approved and in place. Otherwise, you're working through. We've seen some of our counterparts in Cameroon who want to build FLNG plants, and the government steers them to do something that they don't want to do. Effectively, the entire project's on hold and has been on hold for the last 4 or 5 years. I'm sure Roger's experienced that in his time as well. So you've got to make sure as a management team, and I think Chris said an important aspect is the management team to be able to understand what asset they're looking for, understand where the monetization is going to come from, and most importantly, how we're going to get paid and if we're going to get paid. Because you could have a fantastic project, if the return is not there, the entire thing crumbles in the end. So you've got to think through the entire value chain all the way through, and ensure that the project is going to be right and be carried through, and hopefully an exit at some point. Ignacio made a comment earlier in terms of, I guess, financing and funding and running some of the projects. One of the things that we've found is we've got some local bank debt, and in terms of on the currency point, we have taken Cameroonian franc loans, 15 billion ZAF on one of them, and just on a 10 billion ZAF on another one. We don't take any currency risk, obviously, in that sense, because we sell the gas and it's a US dollar contract converted using the prior month's average currency exchange rate, and we get paid in ZAF. We pay our debts in ZAF and pay our expenses in ZAF. So there's sort of a minimal currency risk element there in that sense. And we're not at the stage of profits at this stage. We're paying dividends. But one of the things that we have found is local banks have got some restrictions with the central banks in terms of their balance sheet requirements, number one. Secondly, their lending criteria, maximum 5-year loans. These are infrastructure projects. 5-year loans are not sufficient for us, and we do need the likes of the IFC coming in with a longer term view. I know private equity usually have a 3-year turnaround in terms of their money, so I don't think there's any help for us in that sense. But I think the likes of IFC, the World Bank, I'm talking to Garantco at the moment, who's another entity which I'm not sure if you know, but they're coming with tenor extension facilities where you pay a small fee, 1 or 2%, and you end up halving your principal interest repayments or principal payments and extending the tenor for 13 to 15 years sort of thing, depending on the kind of project. So we need, as operators, we need more of that, because banks, as much as they realise infrastructure and they want to have operators like us invest in their country, they're limited by central bank regulations to be able to give us loans to a certain point. So we need that third party, the IFCs, the MIGA or Garantco, to come in, charge us a small fee. It's normal, they're deploying their own capital in that sense, and they need to get a return on that. But we need that to be able to continue laying that infrastructure to grow in the country. And I think that's a factor that I feel is missing. We can talk about this, and I think Roger said it very quickly. What are we going to do about it? We need the deeper pockets and the bigger checkbooks to come in and say, guys, we'll support you on that. Roger?
Maybe just add to that. If you look elsewhere, there's an alternative to that, which is construction finance from banks and long-term takeout from development funds. And you see that happened in Brazil. So you had Brazilian banks took construction risk, which is higher risk, understood it, got paid for it, and then BNDES, which was the sort of government bank, took those out. And that's something that's lacking in Africa, right? And I think the reason why it's lacking is and we've tried to push this before, and you get the answer, we don't do refinancing. So development banks, funds, and everything else don't do refinancing. If you finance it in the commercial sector, we've assumed you're done. But the reality is you don't get there in the tenor. So that's one option. Rather than have tenor extensions, is actually, why don't you just regenerate commercial bank loans and let them take 3-4 year risk? And then the development fund goes in long term for 10, 15 years is what projects need.
Yeah.
I would just
don't
pick
think
up
we
on.
have many.
Sorry, I would just pick up on one comment as well. I think in terms of private equity, you definitely can't take the sort of model that you'd have in North America or Europe in terms of flipping an asset in such a short period of time. I think Africa, particularly from an infrastructure fund perspective, it's more long dated, 10, 12 years, an investment period of around 7 or so, and then you have a nice approach to kind of an exit period, because you recognize that the availability of kind of, if you're pushing your exit earlier, it's going to be much, much harder. The challenge really with why there aren't as many infrastructure funds on the continent as possible, it's a bit of a circular issue in terms of you need to demonstrate viability on the pipeline to kind of commit. And most of the commitments that are coming into infrastructure funds in the continent is actually development banks who are backing it. So hence there's an agenda in place, but it's having that pipeline in place.
Maybe just one last comment to Roger and Hamid's point. I think you're right. I think the development of the financial markets, whether it be local, just international financial markets, is actually quite key. I mean, we've been trying to do that in the more developed markets by, even for example, us, issuing local currency bonds, trying to put sort of longer term sort of money out there. And our financial institution colleagues are working a lot with private banks in these markets. But it is, I think, a key, particularly for the second stage of infrastructure growth, is to be able to unlock that local currency market and the longer term market. So, yeah, I think point taken. I'll talk to my financial market colleagues.
I think on this note, we are just on time to finish this session. And just give a big round of applause to all our panelists.